Let's stay on the markets here, though. The risks stemming from inflation are becoming increasingly top of mind to policymakers at the Federal Reserve, says our next guest. Rick Rieder is BlackRock's global fixed income CIO and joins us now. Rick, always a treat to see you. Thanks for hopping on here on this Friday. Look, the markets are really have been on an impressive run. Are you getting concerned by how fast asset prices are increasing?
I mean, you always have to keep an eye on it. You always have to look at where valuations are. There are parts of the market. Quite frankly, I think at fixed income is where the valuations have gotten aggressive. Parts of the high yield market have definitely gotten high. Say broadly across some of the credit markets. And the rates market. I mean, if you think about it, you can't justify these interest rates given the inflation we're seeing. I don't think rates are moving that much higher, but I think they're going higher. I have to say, I don't think equity valuations are that high when you look at free cash flow yields. Certainly when you look at relative fixed income, when you look at free cash flow yields, you look at your earnings yield, and boy, in the last couple of weeks, some of the numbers we've seen, some of the earnings numbers that we're seeing print are pretty impressive. And I think one thing that people underestimate with companies, and nobody talks about, when you get inflation and companies can price it through, almost like we've never seen before that's happening today. A lot of their costs are fixed. So if you think about it, some of your costs are variable, some are fixed, and you could price through these increases. The operating leverage you have as a company is pretty substantial.
Yeah, that's what we've been seeing, which is so fascinating, Rick, especially given the expectations that we were going to see big operating margin compression. And in many cases, that is just not happening. So it sounds like then that you think stocks have more room to run. On the flip side, are you guys short treasuries, for example, if you think rates have not moved up enough?
We are, but we're underweight treasuries for sure. And we've moved it around a bit in terms of parts of the curve. But listen, I think these where we are in terms of nominal interest rates doesn't make a lot of sense given the inflationary dynamic. Real rates are too low. That being said, you have to be respectful. We're not that underweight because you have to be respectful of the fact that the demand for income, the demand for yield is extraordinary today. And every time rates move up, you see this wave of money that comes in. So I think, we call the beginning of the year, and I felt like a bit of a dope earlier in the year when rates are rallying. But we think 1 5/8, 1 3/4 is about the range for the 10-year, and then maybe a little bit higher next year. We got pretty close to that. Now we're a little bit through that range. So at these levels, we definitely would be better sellers than certainly when we start to move up again.
And Rick, what's the base case there at BlackRock for how many rate increases we could get, if any, in 2022?
I mean, I'm pretty resolute in my opinion that this Fed is going to move a couple, 1 to 2 times next year, and then a couple, certainly 2 to 3 in 2023. But a lot is going to happen. We're staring at some pretty unbelievable inflation numbers coming in. The CPI report. It wasn't just the sheer number, it was the pervasive nature of it across virtually every category. The next 2 months, you're going to continue to see strong inflation numbers. And then as you get into the spring, some of this is going to come off. Some of it's supply chain, certainly that is going to come off. There are base effects that take place. Some of the energy dynamics as you get into the spring are going to be different. So, Fed's going to be faced with, we're in over the next couple of months, we're going to see this, what is still going to be some pretty heavy inflation data, but then it's going to start to ameliorate itself a bit. So listen, I think the Fed has got to start moving. I've said for a long time, I think they're waiting way too long. And I think they have to start moving. I think they're ready to do that. And then I think we're going to start to see those rate hikes. But I think they're going to be patient on raising rates, more patient than I think people have now started to overshoot the other way on in terms of how fast they're going to go.
Well, Rick, we've been waiting too long to see who the next Fed chief will be. I mean, do you envision any sizable market moves if we do get a change atop the Fed?
So I think, I would say it depends who you are. I mean, as a market practitioner, I think you'll see some movement. I think, the characterization that Lyle Brainerd is more dovish will impact short-end interest rates will do better than if it was Powell. And then, you could see under a Brainerd dynamic, some steepening of the yield curve. At the end of the day, it's really for market practitioners because personally, I would say that their policy ultimately, I don't think will be as different as people are characterizing. Maybe Lyle Brainerd's a little tougher on the regulatory side, but I don't think the characterization of the two, as Brainerd is dovish, Powell less so, I think the world likes to characterize things in one-word answers. I think they're both going to be pretty thoughtful about, gosh, time to move. We got to get off of emergency policy. And I don't think the dispersion of what they actually do will be that dramatic. But markets will react. Certainly the curve, you'll get some moderate curve shifts on the backside of this.
So, Rick, do you think that the administration is making a mistake here by not just coming out and telling the market who the pick is?
It's hard to say behind the scenes what some of the machinations are around who you have to float it to and how you have to garner votes in support of it. But I would say, somebody in the markets every day, I'm ready to go. The markets become laser focused, myopically focused on the shark closest to the boat in all regards. And this one is like, we just need to know this so we can move on to the next thing. So we're ready to go. And like I say, from a market perspective, I ultimately don't think it'll be that dramatic a difference. So, but again, what happens behind the scenes around garnering support for either candidate, clearly there's some politics around that.
Rick, if we are, in fact, if it is correct that the Fed is behind the curve on inflation and they may have to raise rates quicker next year, what does that mean to the broader stock market?
Listen, I mean, if they really have to, and again, I don't think that's going to happen, but by the way, you can't write it off. There are going to be some stickier parts of inflation. Wages are going to be stickier. Rents are going to be stickier. So they're parts that are going to be hard to bring down. But so you could have that dynamic that have to move faster. Yeah, clearly it will have a negative influence on the equity market. But I think people tend to go in themes. And if you go back a month ago, it was all about there's no inventory, there's supply chain shocks. If you look at the earnings numbers this week, what blew me away more than anything else is actually look at the inventory numbers. Walmart, Home Depot, Target, Lowe's, I was going to Mattel the other day, TJX. Their inventory numbers they've been able to restock. They're up, literally year on year up 20, 30%, or over the 2 years up for those sort of numbers. It's really impressive. When you look at the retail sales numbers, people are selling things. So there's some supply chain issues that are taking place in parts of electronics, autos for sure. But I think the growth of the economy and the demand that's out there is going to be pretty impressive going into next year. So will the Fed have to accelerate faster? It'll be because of this demand, which I think is durable. I think that demand will continue. It'll be because you don't have, quite frankly, I don't think it'll be driven by wages will continue to accelerate and how that transmission works. But again, I don't think the base case is that it's going to be an accelerating runaway inflation. I think you'll see some of this ameliorate into the spring.
And Rick, just quickly, we've talked a lot about Thanksgiving costs and turkey costs on this show as a marker of inflation. I don't know if you're the turkey shopper in your household or maybe just the carver, but that disconnect that we have seen between inflation, people complaining about inflation, but then spending, to your point just now, have you been surprised by that?
Yeah, and by the way, we go out, so I'm just the eater in the
lucky
in the family. But we are, by the way, one of the things that I probably should have mentioned as well, food costs are a concern, and that is another one that's stickier around some of these others. Food costs are definitely there. Is an ag dynamic that is definitely working through on the inflation side, and so some of that will continue to play through. And it's something that we're certainly focused on and going forward. But like I say, I think you're seeing some of these things will start to work its way through. And I think one of the things that I always try and put in perspective around, where are we today, where are we going to be T+1, where are we going to be in 3 to 6 months, is technology, the evolution, and you've been talking about it on the show today and otherwise. The technology that's coming through the system, I think people underestimate, including in food. So what happens is when you get bursts in price, like I've never seen in my career, when you see bursts in price in any area, all of a sudden technology comes in through efficiencies. And I always feel like margin today is where entrepreneurialism follows tomorrow. And I think, one of the things, across, you talked about EV, no doubt, you think about how energy is transforming, you think about, higher oil prices, that system is changing. So anyway, one of the things I try and think about from an investment point of view is what's everybody focused on today? Where are we T+1? Where's the world going to be focused on? And I really think technology is a place people underestimate of how it'll influence particularly prices.
That is a really fascinating point, and especially to our discussion earlier today about robots at Sweetgreen, perhaps down the line. Rick, it's always great to see you. Thank you so much for being here. Rick
Thanks for having
Rieder
me.
of BlackRock. Happy Thanksgiving to you, by the way. Appreciate your time this morning.